Silver crashes 26%. What you just witnessed was not normal. It was not a simple correction. The silver market in a single day experienced a collapse of 26%. It fell from $118 to $85. This decline is the largest single-day percentage drop in modern history. It surpasses the famous Hunt Brothers crash of 1980. It exceeds the violent reversal of 2011. It is an event without precedent in the paper silver market. And yet the most important story is not the crash itself. The most important story is what happened alongside it. While digital prices were plummeting on trading screens, the physical market for silver was experiencing something entirely different. Reports emerged of major online bullion dealers facing overwhelming demand. Websites experienced slowdowns, customer service lines were flooded, order processing delays stretched from days into weeks. This occurred at the exact moment the paper price was falling off a cliff. Two realities moving in opposite directions. This divergence is the key to understanding everything. This was not a market event. This was a system event. It reveals a hidden imbalance that has been building for years, an imbalance between a world of paper promises and a world of physical metal. The official narrative for the crash points to a sudden shift in monetary policy expectations. The nomination of a new Federal Reserve chairman, one perceived as hawkish, sent a shockwave through markets. The dollar strengthened. The reasoning follows that a stronger dollar makes dollar-priced commodities like silver more expensive for foreign buyers, thus reducing demand. This is the textbook explanation, and on the surface it holds logic. But textbooks often fail to capture the full complexity of real-world systems. The fundamental picture for silver did not change in that single day. The structural supply deficit, measured in hundreds of millions of ounces over recent years, did not vanish. The industrial demand from solar panels, electric vehicles, and electronics, consuming over 230 million ounces annually for photovoltaic cells alone, did not disappear. The inventory levels in major exchange warehouses, which had been in a steady decline, did not suddenly rebound. None of these underlying conditions were altered by a personnel announcement. What changed was sentiment, and in the paper-silver market, sentiment is amplified by immense leverage. Algorithms programmed to respond to interest rate expectations triggered a wave of selling. That selling hit stop-loss orders, which triggered more selling. Margin calls forced traders to liquidate positions, creating a cascade. The paper market, a realm of derivatives and contracts, executed a violent and rapid repricing based on a shift in perception. But perception is not reality. The reality of physical scarcity operates on a different timeline, governed by geology, mining output, and industrial consumption. The paper market can reprice in nanoseconds. The physical market cannot be manufactured so quickly. This brings us to the core fracture, the growing chasm between the paper market and the physical market. They are becoming two separate worlds. The paper market is vast, liquid, and digital. On exchanges like the COMEX, the volume of silver futures contracts traded in a single day can represent multiple years of actual global mine production. It is a system of financial instruments where most participants never intend to take delivery of a single ounce of metal. It is about price speculation, hedging, and financial engineering. The physical market is smaller, slower, and tangible. It involves the actual metal, bars in vaults, coins in dealer inventories, silver paste on solar cells. This market is concerned with logistics, refining capacity, and the simple availability of a material. The link between these two worlds is supposed to be maintained by arbitrage. If the paper price is too low, someone should buy paper contracts, take delivery of the metal, and sell it in the physical market for a profit. This action would lift the paper price and balance the system, but this mechanism is straining. The recent crash exposed this strain vividly. As the paper price collapsed to $85, the premium required to buy a physical ounce of silver from a dealer did not collapse. In many cases, it expanded. Reports indicated premiums spiking by $15 to $20 or more. So while the screen price said $85, the actual cost to obtain a silver coin or bar was often over $100. This is the disconnect. It tells you that the price on the screen is becoming less relevant for those who want the actual thing. The physical market is setting its own price based on its own rules of availability and immediate demand. The evidence for this physical tightness is found in the data from the vaults themselves. Inventory levels are a critical heartbeat monitor. In the COMEX warehouse system, there is a distinction between total silver and the smaller category of registered silver, metal that is specifically available to meet futures contract deliveries. This registered category is the crucial buffer. Recent data showed this registered inventory at just over 30 million ounces. Meanwhile, the open interest in a single active futures contract month like March represented potential delivery demands for over 500 million ounces. The arithmetic is stark. There is a leverage ratio of paper claims to available metal that exceeds 16 to 1. This means if even a modest percentage of contract holders decided to stand for physical delivery instead of rolling their paper contracts, the system would face a severe challenge. This is not a theoretical concern. We have seen precursors. In late 2025, a significant arbitrage opportunity between London and New York led to a massive movement of metal, draining millions of ounces from COMEX vaults in a single month to meet acute shortages elsewhere. This movement caused lease rates, the cost to borrow physical silver, to spike to extraordinary levels, sometimes over 100% annualized, compared to a normal background rate of less than 1%. These are not signs of a plentiful, calm market. These are signs of a market under duress, where the physical metal is becoming hard to locate and expensive to borrow. The day of the crash, these underlying vault stresses did not magically resolve. They persisted. The paper price moved independently. What is the motive for large financial institutions within this system? It is primarily one of risk management and systemic stability. The banks and entities that act as market makers in the paper, silver market are not necessarily villains in a story of suppression. They are facilitators of a system that has operated for decades on a foundation of high paper leverage relative to physical stock. Their business depends on the smooth functioning of this derivative market. When that market experiences extreme volatility, as it did during the 26% crash, it threatens that smooth function. It can lead to cascading failures, broken trades, and counterparty risk. Therefore, these institutions have a vested interest in managing volatility, in providing liquidity, and in preventing a disorderly market seizure. Their actions, such as increasing margin requirements, which forces leveraged speculators to put up more collateral or close positions, can appear to be driving prices down. And in a moment of panic, they can have that effect. But from their perspective, this can be a defensive move to reduce systemic risk and prevent a more catastrophic failure. They are not necessarily betting against silver forever. They are often managing the immediate peril of a leverage explosion. The problem arises when the systemic need to manage paper leverage clashes directly with the physical reality of a shortage. You can raise margins to force paper speculators out, but you cannot raise margins to create more physical silver. The tool used to calm the paper market does nothing to address the physical deficit. It may, in fact, exacerbate it by creating a lower paper price that incentivizes physical buying, further draining vaults. For the individual investor watching this unfold, the psychological landscape is incredibly difficult. It is designed to induce confusion and fear. You see a catastrophic crash in price. The natural emotional response is to associate that with danger, with loss, with a broken thesis. The urge to sell, to avoid further pain, is powerful. This is compounded by the mainstream financial narrative that will explain the crash in simple terms. Strong dollar, hawkish Fed, bubble popping, yet simultaneously you may hear contrasting reports of physical shortages, of dealers overwhelmed with orders, of long wait times. This creates cognitive dissonance. Which signal do you trust? The crashing number on the screen, or the reports of frantic physical buying? This tension is the essence of the trap. The volatility is weaponized to shake out those who do not have a firm grasp on the difference between a digital price for a paper contract and the market for a tangible asset. It preys on the short-term mindset, on the fear of being wrong in the near term. The investor who bought silver as a long-term hedge against currency devaluation or as a play on industrial demand is now faced with a test. Do the reasons for holding the asset still exist? The answer, looking at the unchanged fundamentals of deficits and demand, is likely yes. But the emotional toll of seeing a 26% loss in a day is immense. It requires a discipline to separate the noise of paper market liquidation from the signal of physical market stress. So, where does this leave us? We are left observing a system in a state of high stress. The path forward is not predetermined, but several scenarios are plausible. In one scenario, the paper market's violent reset succeeds in its goal. Leverage is reduced, speculative fervor cools, and the paper price stabilizes at a lower level. Physical buyers, faced with high premiums and delays, become hesitant. The system manages to limp forward, and the extreme divergence between paper and physical narrows slowly. The immediate pressure on the vaults eases. In another scenario, the paper crash has the opposite effect. It is seen by a critical mass of players as a massive arbitrage opportunity. They demand delivery on their low-priced paper contracts, intending to capture the metal and sell it into the high-premium physical market. This could trigger a sustained drain on exchange inventories, pushing lease rates higher and making the physical metal even harder to secure. The system would then face a difficult choice: change the rules to avoid delivery or see its vaults emptied. A third scenario involves a more permanent decoupling. Investors burned by the paper volatility and attracted by the physical scarcity abandon paper vehicles like ETFs and futures in greater numbers, opting instead for direct ownership of metal. This would further weaken the relevance of the paper price discovery mechanism, leading to a world where the true price of silver is set in the physical market, with the paper market becoming a volatile, sidelined derivative. These are not predictions, but possibilities. Each hinges on the reactions of different market participants: the industrial users, the sovereign funds, the leveraged speculators, and the individual holders of physical metal. The 26% crash was not an ending. It was a dramatic symptom. It revealed the intense pressure building at the fault line between two increasingly separate worlds. The paper world can crash in a day. The physical world, governed by the slow turn of minds and the insatiable needs of industry, moves to a different rhythm. The story is which of these worlds will ultimately dictate the true value of this ancient and now indispensable metal.